Welcome back to the channel. Today we're testing a strategy with a truly humble title. My new favorite EMA settings, impossible to lose with this strategy.
Imagination.
Yeah, impossible to lose. Bold claim, but naturally I had to find out what happens when you actually run it on real data, across multiple markets, across multiple years, instead of cherry picking the three prettiest trades on a chart. Spoiler, definitely possible to lose. But let's be fair, let's actually build it, test it properly, and see what we're dealing with. But first, let's watch the intro.
You're gonna learn perfect EMA settings and then a very accurate trading strategy that makes consistent profit. Just make sure you
Okay, sounds good. Let's get into it. Let's explain how this strategy works. You'll have to trust me that I followed the video, as I don't know YouTube's rules for using video snippets, and its explanation is quite long. The strategy uses 5 EMAs, all stacked on a price chart. Here's the setup. 2 5-period EMAs, one on the high price and one on the low price. These form our tight white channel that hugs price closely. 2 100 EMA with a high and a low price again, and this creates our wider green channel, slower to react. Finally, we have the 200 period EMA, which is on the close price. This is our big orange line. This is your trend compass. The logic goes like this. The 200 EMA tells you which direction the market is trending. When price crosses it, you start looking for a setup. You then wait for the fast white channel to confirm this new trend direction by fully crossing our 200 period EMA. Once this happens, we wait for a pullback into the green channel. He's very precise about this and says the price must overlap into the green channel. Our last confirmation before finally entering is when price closes out of the white channel in our direction. Our stop loss goes outside the green channel, and our take profit is 2 times the risk. It's pretty simple. On paper, it looks pretty clean. On cherry-picked charts, it looks even better. Before we run any backtests, let's be upfront about what we had to decide when coding this, because every backtesting decision is a hidden assumption. First of all, we ran all backtests on hourly charts, like the video, and made sure the date range included his examples, but went far beyond it for a fuller test. Assumption number 1. The strategy says price crosses the 200 EMA, but crosses happen constantly in choppy markets. We added a requirement that all 25 consecutive bars before the cross must be on the same side of the 200 EMA. Without this, you'd be triggering setups every time price wiggles around the orange line. The original video doesn't mention this. We made a judgment call for consistency. Assumption 2. The setup is sequential. 4 conditions must trigger in order. We gave each stage a 50-bar window. If the next condition doesn't fire in time, the setup resets. Real traders might wait longer or abandon it sooner. Your results will probably vary. Assumption 3. We enter at the close of the signal bar. In live trading, you'd get the open of the next bar at best. This is a slight optimistic bias. Assumption 4. We assume a stop or take profit can hit anywhere within a bar's high or low range. This is standard for backtesting, but it can be slightly optimistic. You don't always get filled at your exact price. Assumption 5. Commission and slippage was not accounted for. Clean theoretical results only. Reality will be worse. Assumption 6. While in a trade, both long and short setups are frozen. No trade stacking, as he clearly called this out in a comment. Now let's talk about the code. We coded the strategy from scratch using Python and a custom backtesting framework. No black boxes. At the core is a finite state machine. Think of this as a checklist that must be completed in order. Each bar that passes, we check, are we ready to move to the next step? If yes, we advance. If we run out of time, we reset and wait for a new setup. 5 EMAs are calculated exactly as described. EMA 5 of highs, EMA 5 of lows, EMA 100 of highs, EMA 100 of lows, EMA 200 of close. Our stop loss is placed at the EMA 100 low for longs and EMA 100 high for shorts. Take profit is exactly 2 times the risk distance. Both are checked bar to bar. The code has not been optimized. No curve fitting, no optimized parameters. We took the strategy as described and ran with it. Let's look at some of the examples in the video and compare them to our backtest. Here's a long setup from the original video. Note the date of this trade. Price was below the 200 EMA for over 25 bars, then crossed above. The white channel followed suit, confirming the new uptrend. Price pulled back into the green channel, perfect touch. Then it closed above the white channel. This is where we went long, stop below the green band, 2-to-1 target hit. Clean, satisfying. This is the version that makes you want to fund a live account.
Shut up and take my money.
Let's look at our trade. The strategy took on the same forex pair and same day. Looks extremely similar. The only difference is ours entered the trade earlier because the price actually closed above the white channel sooner. You can even see this on his chart. Not a big deal, just goes to show that manually tracked trades can often involve human error. In this case, it actually allows the trade on his video to have a greater reward because he entered after a more volatile move. This caused his stop loss buffer to be larger and therefore his 2-to-1 risk to reward paid off. Now let's look at a short setup on the different day. Same story in reverse. Price crossed below the 200, white channel confirmed, pull back to green, closed below white, textbook. These trades do exist. The strategy can produce them. The question is how often and at what cost? Before we dive into the backtest results, I want to highlight 2 important caveats that I'm working to improve in future videos. Currently, I only have access to the last 2 years of historical data for stocks, cryptos, futures, and forex. I plan to expand this dataset to allow for more robust testing and future analysis. Also, past performance does not equal future results. This video uses the same or similar time frame as the original video's example. This isn't meant to prove the strategy works long term, but rather show the reality behind many trading strategy videos on YouTube. Finally, I want to stress that this is a factual analysis of the strategy shown in the video. There is no intent to disparage the original creator. Please be respectful. And if you notice anything I can improve or correct, I encourage you to leave a comment so I can refine my approach in future videos. We tested this strategy across the euro dollar and British pound dollar pairs from March 2024 till March 2026. I'd plan to test more markets too, as he claims this works on any market, but once I saw the results on these 2 pairs, I didn't really feel the need to. Here are the full results in the euro dollar pair. Profit factor is essentially a wash. Sharpe ratio is essentially 0. Sortino also essentially 0. Max drawdown and total return were essentially 0, and the win rate was about 50%. I included the position timeline so you can see when and what type of positions was opened. I also included a cumulative return equity curve for the strategy versus buy and hold. What about the British pound and dollar pair? You can pause if you'd like, but nothing notably different here. The strategy is inherently a trend reversal setup. It needs clean, quick moves. That's not always what the market gives you. I believe there is some room to filter out false positive breakouts by possibly utilizing the 200 period EMA slope and percentage of below or above prices over a smaller lookback, but that's nothing more than a hunch. If you're interested in the combination of both tests, I've wrapped it up in a summary report, but honestly, there's not much to go over. In this top section, we show the averages across both the runs. This section here is a blended timeline as if you were to take all the trades across both of them. And then we have the same equity comparison here across all of the holdings and the combination of them. For example, this is the combined strategy versus the combined buy and hold. At the bottom, I also added extremes. So we have the worst max drawdown, the least severe max drawdown, and the best total return and the worst total return. Honestly, it's not a disaster. It's not a fortune. The truth, as usual, lives in the boring middle here. Here's the summary. The EMA Band strategy is a structured, rule-based trend reversal system designed to identify and trade potential turning points in the market with clear entries and defined risk. That's not nothing. A lot of retail strategies don't even have that. But here's what the original video doesn't show you. The setups that fail mid-sequence. The trades that get stopped out. The months or years where markets don't cooperate. The difference between cherry-picked examples and systematic results. Great takeaways here. Every strategy needs full historical testing across multiple markets and timeframes, not just 3 pretty examples that made the thumbnail. Your backtesting assumptions matter. Entry timing, stop placement, and filters all affect your results, and some of those choices are invisible unless the code is open. A structured approach with defined risk is better than no system, but impossible to lose should always be a red flag, not a selling point. Anyways, Which strategy should I test next? Comment below, and I'll see you guys next time.